right, what's happening, everybody? Welcome back. Continuing our discussion of investments in other companies, whether it be stocks, bonds, whether the stock is common stock, preferred stock. Now we're going to focus in on common equity. We already know if you have no significant influence, how are we going to account for that? Trading security fair value through P&L. Our discussion now is moving to, no, we do have significant influence. Generally, that's evidenced by your stock ownership. So with common stock, you can have significant influence. You're going to use the equity method of accounting. And then later, we will cover, well, when you have control, you're going to have to consolidate. We're saving that for the end. That'll be the big cliffhanger. Can't get the words out. All right. So when do we use the equity method of accounting? You're looking for 2 words on the exam. Significant influence. And by the way, the repetition, the more times you hear it, you read it, you write it, you'll remember it, you'll take the exam, and then you can forget it. But actually, a lot of people don't forget it. Years later, you'll be contacting me on LinkedIn and be like, you nut, you owe me coffee, and I'm still thinking about investments in affiliates. All right, so when to use the equity method of accounting? As a general rule, you own at least 20, but not more than 50, but that's only evidence. Look for significant influence. It's possible you might own less than 20 and have significant influence, or maybe you own more than 20, but for whatever reason, the facts indicate you don't have significant influence. Okay, you're going to consolidate as a general rule when you own more than 50%, but really the key for consolidation is control. You might not consolidate even though you own more than 50 because you don't have control. So what happens if you own more than 50% of another company, but they tell you on the exam you don't have control? Well, then you can't consolidate. Then what are you going to do? Well, you'll use the equity method of accounting. But I don't get it. If you own more than 50%, why wouldn't you have control? Why is there a lack of control? I don't know. Maybe the company is currently in bankruptcy and the company is being controlled by the bankruptcy trustee. Or maybe this is just going to be a temporary investment. And as a result, we don't have control. We're not exercising control. All righty. So you own 20 to 50. You're thinking equity method. You might own more than 50. You're thinking control or consolidate. But if they tell you for whatever reason you don't have control, then once again, you'll use that equity method of accounting. Okay. So if you own at least 20, but not more than 50, you own, and remember, it's got to be the voting stock. Remember, when it's preferred stock, general rule, you don't have any voting rights. So if it's preferred stock, you're going to count for that. How under U.S. GAAP? Fair value through P&L, trading security. Okay, so you own the voting stock somewhere between 20 and 50. It's presumed. So unless they tell you otherwise, folks, it's presumed that, yeah, you can exercise significant influence. There would have to be something in the facts to overrule that. But if they say nothing, then just the 20 to 50, you can presume they exercise significant influence. Now, you've also got to use the equity method of accounting in another situation where you own more than 50% and you are going to consolidate. Well, I don't get it. So why would you do the equity method if you're eventually going to consolidate? Because that's the thing. The parent company and this subsidiary are going to have their own standalone financial statements. And then later on, they will get together and consolidate, combine their financial statements. Now, the parent company's standalone financials prior to consolidation, they still have to account for this investment. And on their standalone financial statements prior to consolidating, they'll show that investment in affiliate. They'll have that equity method of accounting. And then you'll learn how you're going to take that out of the equation when you consolidate and replace that with assets and liabilities and all that good stuff. So equity method is crucial, man. You got to know it. Very important. Okay, so equity method, when you see that on the exam, dividends on the common stock are not income, folks. Dividends on the common stock, not income. You're going to see that that's a return of capital. So when you see equity method, you think significant influence and then immediately think dividends are not income. They're going to be a return of capital. And do not mark that to fair market value. Under the equity method, I'll show you how to adjust from the beginning carrying value to the ending, but you do not mark it to market value. Okay, just make sure when you read the facts, the passkey here, they like to mess with you and somebody might own less than 20, but nonetheless have representation on the board and exercise significant influence. Then you'll use equity method. Or they'll tell you, hey, we own 25, but you know what? We don't exercise significant influence. Well, then you can't use the equity method. You'll have to account for it fair value through P&L. Or we own more than 50%. You're thinking control. We're going to consolidate. Well, maybe we're not going to consolidate because we don't have control. So you'll use the equity method. And even if you have control, and you are going to consolidate on the parent's own standalone financial statements, the parent is still going to use what? The equity method of accounting. So what do you think? Is the equity method going to be tested or what? Okay. When is the equity method not appropriate? Here are the things in a fact pattern where they're going to try to tell you without coming right out and saying it, there is no significant influence, okay? So the equity method is only appropriate if you have significant influence. So what are the factors you'd have to look for? Even though you own at least 20, you don't own more than 50, you're between that 20 and 50, but what are the factors? Maybe we're in bankruptcy. Maybe the investment is only temporary. Maybe there's what we call a standstill agreement. The investor is surrendering their rights as a shareholder, so they're not exercising any significant influence while under this standstill agreement. Maybe a small group has majority ownership and they're keeping us out of it. Even though we own 25% or whatever, they're operating the company without regard to us. That's not very nice. They're not letting us play. But nonetheless, no significant influence. Or to use the equity method of accounting, you have to have access to the financial information for that company you've invested in, the investee. I need to know what their earnings are because my percentage share of those earnings are going to go on my income statement. I need to know what the dividends are because my percentage share of the dividends is going to be a return of capital, etc. I need to know what the book value is versus the fair market value of the assets because I'm going to have to calculate what's called excess depreciation. If you don't have access to that information, you're going to see then you can't possibly do equity method. Or another thing they'll throw in the facts, you can't get any representation on the board. You've been kept off the board for whatever reason, therefore you can't exercise significant influence. So they'll make it very obvious, okay, folks? They just want to make sure you're not straight out memorizing the percentages and not really understanding the concept. All righty. So that's our brief introduction to the equity method of accounting. Come on back. Don't do any questions yet. Come on back. Let's bang this out.